In this week's update, Italy overcomes political impasse to soothe markets, G7 leaders hope to talk Trump down from the brink of a trade war, and the global economy picks up pace. The week began with markets on the front foot after fears over a potential new euro crisis ebbed away. Prices fell sharply last week as markets wondered whether Italy could soon agitate to leave the eurozone, a step that many believe would pose a systemic risk to the currency. A new week and a new optimism, with the political impasse that threatened that scenario seemingly resolved. The saga began in March with the Italian general election that resulted in a hung parliament. The parties since then have been cutting deals to see who among them could form the government. The upshot has been that two non-mainstream parties have formed a coalition that now enjoys a parliamentary majority. There's the left-wing Five Star Movement and the right-wing Lega Party. The reason they've been able to agree a coalition is that both have big issues with the EU, in particular with what they see as a lack of support in dealing with refugees arriving from war zones in the Middle East, as well as with tough austerity rules that have squeezed Italian households. The Italian system means that winning parties in an election nominate their ministers to form the government, which then have to be approved by the country's head of state, which is President Sergio Mattarella. The coalition put forward as finance minister an 82-year-old economist called Paolo Savona, but the choice was rejected by the president on the grounds that Savona was too anti-Europe. The new coalition was outraged by this and refused to appoint a government. At that point, there was a real possibility that a new election would be needed. This spooked markets because, in that scenario, the two parties which had just won an election and which polls suggested were even more likely to win another one, could have campaigned to leave the euro altogether. In the days that followed, however, the new coalition has been able to set aside its objections and finally agreed a new government. Markets responded and, at the time of writing on Monday, had recovered much of the ground lost last week. The Stoxx Europe 600 index was up 0.5% on Monday. The FTSE 100 climbed even further to 7,768 points. The S&P 500 also recovered following a dip, reaching 2,734, and was helped by stronger than expected non-farm payroll data on Friday. Markets seem to have taken solace from the fact that, when push came to shove, the populist parties of Italy were not quite prepared to push for the country's exit from the euro. With the passing of one crisis, however, there arrives another. This time the revival of fears of a trade war instigated by the US. Last Thursday, the US said tariffs of 25% on imported steel and 10% on aluminium had come into effect. They apply on items such as plated steel, slabs, coils, rolls of aluminium and tubes, raw materials that are all used extensively across US manufacturing, construction and the oil industry. There had been hopes that tariffs could have been avoided for some trading partners, but the US confirmed that talks with the EU, with Canada and Mexico had not made enough progress to warrant holding off. Metals are not the only battleground. The US has threatened a wider package of tariffs, including a 25% charge on a range of Chinese imports. China, along with a host of other trading nations, is now preparing retaliatory measures. Underlying the conflict is President Trump's problem with his country's trade deficit, and in particular its deficit with China and that country's asymmetric treatment of home and foreign companies. China makes foreign companies investing in the country partake in joint ventures with native companies, including sharing technology and intellectual property. And there's lots of examples of this then being shared with the state or used outside of the joint venture. The G7 group of leading economies is meeting in Canada with trade high on the agenda. So far, markets have been relatively optimistic that they will be able to reduce the tensions, but expect volatility if there is a worsening of the rhetoric this week. Elsewhere, despite the ongoing political scraps, there are signs that the global economy is picking up pace. The latest nowcast readings from Fulcrum show that global economic activity is growing at around 4.5%, returning to the highs of the past 2 years. Growth had been slowing in the advanced economies this year, but the figures suggest that that is now ending. The US and China are both growing above trend, although it's less good news for Europe and the UK, where activity is broadly in line with the long-run average. In UK economic data, the construction sector has made a modest recovery from its bad start to the year, with data from IHS Markit showing that a small rebound in activity continues. That's important because it was the slowdown in construction that has contributed most to the worse than expected reading of UK GDP in the first quarter. That helped the pound on Monday, which rose to $1.34 against the US dollar, while the pound to euro exchange rate was slightly lower at €1.14 as the single currency recovered from events last week. In commodities, oil prices were stable after falls last week. Brent crude was trading at around $77 a barrel and US light crude at $66 a barrel. Data last week showed an increase in production of oil in the US. The easing of political tensions in Europe saw the price of safe haven gold slide, and the metal was worth $1,289 an ounce. Finally, in the corporate diary, there's news this week from WH Smith, Auto Trader and Mighty. That's it from me. Have a great week.